Good evening. This is Daniel Jacobs. I'm with TruLoan Mortgage, and I see that we have some folks still logging in for our Real Talk about Millennial Homeownership event. So we're just going to put ourselves on hold for about a minute or two, and then we'll get started briefly. And if someone can just confirm for me that that what's on the screen is the slide is primarily what's up. Is that right?
Yep,
Matt?
it's there. Yep.
Okay, perfect. So again, I'm Daniel Jacobs. I'm the managing director here at TruLoan Mortgage, and I'm really excited to have so many of you join us this evening to talk about homeownership. Very exciting. Normally, we like to do these in a fun place, at a brewery. We were doing these in person, having a lot of fun before COVID hit. So now we're doing this virtually, as you know, but don't worry, we're gonna make sure to keep it fun. We're gonna keep it interactive. Still gonna give you an opportunity to go have that beer when you wanna go on your own, not in a big group, okay? So we'll talk about that in just a moment. I wanna let you know who is on our panel tonight. We've got a really exciting group. So I'll be the host and your moderator. We've got Nick McCree, top agent in town with eXp Realty. We have Matt Wise and Brenda Jarvis, my colleagues. All of us are founders here at TruLoan Mortgage. We are a local boutique direct lender, and we specialize in working with millennial homebuyers. So we're really excited to have this panel. Before we get started with the panel, I want to tell you what's going to happen, just in case you have to get off early. We hope you stay till the end, but a couple things are going to happen. At the end, you're going to get an email. And in that email, you're going to have a download link. There's going to be two documents, really important. You'll see on the image here. One is the Smart Guide to Home Buying. This is a custom document we have put together, walks you step by step through the home buying process. It'll explain what each step means. It defines it. It says what you need to do, what you need to not do, what we'll do, and how it progresses from step to step. All that starts to make more sense after talking with us tonight and going through the rest of the process. The other document, just a group of articles that we've assembled that we think are just really interesting and helpful for new home buyers, particularly millennial home buyers that may be wondering about student debts or how the Charlotte market is doing in light of COVID. There's a lot that's going on in there that is just interesting reading, okay? So you'll have those downloads available. You can also forward those download links to friends and family who you think might have an interest in this subject matter, but we're not in attendance tonight. In addition, everyone that is here tonight, if you decide that you would like to get pre-approved to understand what you can buy, whether you're looking to buy next month or next year, it doesn't matter. If you get pre-approved because you attended tonight, remember I said we usually have fun. We usually have some appetizers and some beers. It's okay. We're gonna give you a $50 gift card. So you can go to Legion Brewing, where we used to do these a lot. We did several breweries. We love Legion. We're going to get you a gift card to go there when it's convenient for you to go have fun. Second, if you go on our calendar link, and you'll get that with the link I mentioned a few minutes ago with the documents, you're going to get a link where you can schedule a time for that pre-approval. You don't have to do the pre-approval by Monday. You just have to get on the calendar and book it. You can do it in 2 weeks, 3 weeks, 4 weeks, whatever. And again, it doesn't matter whether you close next month or next year. By scheduling that and just getting the process started toward homeownership, we're going to make a note in your file that we're going to give you a $500 closing cost credit from TruLoan Mortgage at the time as you close. In addition, Nick McCree and the eXp team have also, they're going to contribute $500 rebate toward your closing costs from their commission that they earn from selling the house. So you got $1,000 plus $50 for food and fun. So watch your email for all that after the event is over. Oh, wait a second. I'm going to back up before we go to the next one. So I told you, normally we keep this interactive in person. So let's just talk about this. Everyone's gotten used to using Zoom for something since COVID, right? We're used to using mostly the Zoom meetings. This is on Zoom webinars. Couple differences. First thing, you're going to notice you're only going to have 4 faces. Right now, I've got it showing the screens, okay? After we go from that, when we start our panel discussion, you'll see the 4 panelists. You don't see each other. It doesn't show all the attendees. That's one of the differences. The other thing is I want you to just get acquainted with, depending on whether you're using a Mac, an iPad, a laptop, whatever, it shows the controls a little bit different. So I want you to take a moment and look at those controls. When you look at those controls, there's gonna be 2 ways that you can interact, because we want to keep this interactive, okay? So there's 2 things. There's the Q&A. You can type questions in. We're gonna read your questions. We're gonna answer them. That's how this is gonna work. Make it as interactive as we can. The other thing is I want you to look at the chat feature, okay? So there's a chat, and I want you to go ahead and grab that right now, and I want you to see where you can type into that, okay? Because I'm going to ask a series of questions really quickly, and I want you to just put your answers in. As much as anything, I want you to just, click it to get used to using it, okay? And then when we get to the panel, please, this doesn't work if you're not asking your questions. We want to answer what you want to know, and we'll also have some information to make sure to convey in case you don't ask certain questions. So this is driven by your questions, okay? All right, so first, we're going to keep this a little fun, and before we go to start the panel, all right, first question, go to the chat. Average down payment among first-time homebuyers is what percentage of the purchase price? You can just do A, B, C, or D, 10%, 6%, 20%, or 3%. Let's see, what kind of answers do we have? I got a C, I got an A, I got an A, I got a B, all right, yep, C, all right, all over the place. Let me tell you, the correct answer is B. I can't even read now. It's B. It's been a long day already. 6% is the average amount of first-time homebuyers down payment. I know we've all heard 20% down, 20% down, 20% down. We're going to talk about that a little bit more. There are loan programs with 3% down, okay? So 80%, just remember this, 80% of first-time homebuyers put less than 20% down. Next question. If you're buying a $275,000 home and you decide not to buy it now, you say, you know what, I just want to wait a year. I'll buy it then. You just keep renting, all right? Let's say you're going to put 3% down. So it's minimum down payment, 3% down. At the end of a year, had you bought it instead of waited, how much wealth do you think you would have built between the amount that you pay down on your mortgage, the principal? So every month when you make a payment, you got principal and you got interest. The interest goes to the bank. That's not money you retain, but your wealth is built through the principal pay down. And then in addition to that, the increased value of the home based on the current rate of home appreciation in our market. Do you think that you would have left on the table A, 7,200, B, 31,490, C, 16,291, or D, 3,900? A, B, C, or D? Don't be shy. Type it into the chat. I like it. We got no idea.
No idea.
It's my favorite response. I love it. Okay. No idea. All right. I'm going to give you the answer. It is C, 16,291. And it is really impactful because, you know, when you're making your rent payment every month, when you're making a housing payment, you're building wealth. Every month you're building wealth. The question comes down to whose wealth are you building? Are you building it for yourself at 16,291 for that year? Or are you building 16,291 for your landlord? Now, let's just take the same concept. And let's say if you wait 3 years, it's 50,903, okay? This is the reason homeowners in America accumulate 44 times the wealth of renters. Not in year one, over time, right? It's over time. There have been study after study after study to show this. So really, homeownership helps you just establish wealth in a really meaningful way because of leverage. So next question, the typical cost of using an exclusive buyer's agent versus using a listing agent to acquire a house. What does it cost you as a buyer? 3%, 1.5%, 0, or 6. Now, what I mean by this is, you know, you're going down the street, you see a for sale sign. You can call the name of the realtor on that sign. That's the listing agent. Or you can have your own realtor that represents you on your side of it and not use the listing agent. The question is, what's it going to cost you to have your own representative? A, B, C, or D. And you know, it's really interesting. We got answers all over the place again. And you know what? I'm not going to have a slide for you guys on this. Instead, I am going to, here we go. I'm going to turn over to Nick McCree. And Nick, why don't you answer that for us?
Yeah, so I see a lot of A's, couple D, couple C. You know, the great thing about being in North Carolina is that the seller pays both commissions for the listing agent and the buyer's agent. And so what's great about that is that the answer, correct answer is C, is that for as a buyer in North Carolina, you do not pay anything out of pocket. It is totally free. It's 0% out of your pocket for the buyer's agent. I will collect a commission from the seller when they sell the home. That's their side of the expenses. But the good news again is that I, as a buyer's agent, can represent you. I work for you and only for you. And I do so at no cost directly to the buyer.
Yeah, no, then that's really important. But I want to ask you something on that, Nick. So, look, we've all learned, you know, usually if it sounds too good to be true, it is, right? So my question is this: if I'm a first-time home buyer, and you're telling me I can have my own representative, I can come to you, Nick, and you can show me the houses, and it doesn't cost me anything. First thing I think is this. I hear that, except for I'm sure that if I just go directly to the listing agent, then the buyer, I mean, the seller pays only half the commission and I can get a better price because of it. Well, yeah. Is that not true?
It's totally not true, because what would happen in that regard is that the listing agent would say, oh, yes, I'd be happy to represent you as well. And per the contract of a listing agreement, the listing agent would actually get paid both commissions. So one way or another, when you list a house and you are agreeing to pay that, you know, it could be anywhere, you know, there's negotiable listing agreements and everything. But let's say it's 6%, which, you know, tends to be around the average. So it's 6%. That 6% is either going to be paid both, you know, or all to the listing agent, or half to the listing agent and half to the buyer's agent, normally speaking. You know, it varies. But again, just generally speaking, you could call that listing agent or perhaps even a builder. And I know you were going to get to that, Daniel. You know, even a builder, right? We see the signs. You go into you know, a builder, a model home, and there's a very nice, lovely lady or, you know, guy there that's like, hey, you know, I'd be happy to represent you and help you out. You see that you don't have an agent. You have to understand that, again, in that scenario, they work both sides. They are representing the seller, which is the builder in that case, or the listing agent is representing the seller, and they're claiming to also represent you. That is not true representation for you and you alone as the buyer. And oftentimes what happens, this is what the real estate commission actually directs people in those scenarios. I've been on both ends, actually, right? You know, where I've represented both sides. But what the real estate commission directs, you know, us as agents, if you are in a dual agency, and that's what that situation is called, they represent you to actually, they tell you to actually just moderate. So in fact, when you think you're getting, you know, someone to negotiate for you, you're now having to negotiate on behalf of yourself with the seller, with the agent kind of moderating both sides because they represent both interests, and that is not going to get you the best for your bottom line, which is, you know, to your point, Daniel.
But why not? Okay, because so I want you to dig into that, because this is always a hot topic when we have our live events, you know, and what I want to know is, it would seem to me that the listing agent has inspected the house. They know the house. They know it better than you. Okay, so why wouldn't I want to have them talking to me about the house? Why is it not in my best interest as a buyer to work with the agent that probably knows more about the house?
Well, because there you go. They know more about the house than you do, and they are biased in that regard because, you know, they are implicit in the fact that they want to work for their clients. So let's say there's something wrong with the home, right? I was born and raised here in Charlotte, North Carolina, so I've known real estate here. This is you know, I've been doing this over 3 years now in this market. And one thing you learn is that the repair request stage, the due diligence, where you find out facts about the home, that is when the other side, generally if you're the buyer, the sellers get real quiet, and the listing agents, right? They don't want you to find out everything. And that's where a good buyer's agent who represents you and your best interest can really earn their commission, right? Because, if you are getting represented by the same person who is maybe not wanting to reveal as much as you should know about the home, maybe there is something that that they know that is, that the seller's trying to hide, whether it be water damage or, there's a whole slew of repairs and things. So there's a million things that could, be happening to that home. You want someone in your corner who is going to work for you. And I see here, Nicholas is mentioning, if a real estate agent is getting paid a commission based on the purchase price, how do you know that they are really going to fight for the best price for you? And I appreciate that's a great question. And it's a good point, right? Because based on the purchase price is the commission that you're going to get paid. But us as realtors, especially the ones that truly are in this, for the right reasons, right? I'm in real estate. I'm a real estate agent because I love to help people first and foremost. And it is true that commission does come from the purchase price. But when you have a buyer, a client that you are representing, right? You are only as good as the trust that you have between each other. So if I am working for a client and this is the home that they want, it is my duty, is my job to get you the best price, because that's what I would want. I would want to, have the best agent that's going to represent me and my interests. And if there's something wrong and I can get extra money from the seller to pay for a repair or to come down on the price, because that is my job, then that's what you'll see. And so again, it is with the commission being tied to the purchase price. You got to understand that with the percentage that it doesn't really make a big difference overall. For me, it just, I want happy clients that are going to get the best price and the best deal.
I think really you touched on it earlier. I'll move to the next question, but you touched on it earlier. It really comes down to the listing agent is being paid to represent the seller.
Yeah.
And they're going to only disclose what's required by law. They're not going to get into, all the things that are in the best interest of the buyer. And by having it's kind of like having an attorney, okay? If you are going into a business agreement or you can look at this positively as a business agreement, you can look at it negatively as a divorce. Nobody uses the same attorney on both sides. They get their own attorneys. With real estate, you're getting your own representative to look out for your best interests. And I think through the rest of our discussion, some of that will reveal itself a little more. Nick, I'm going to ask Matt and Brenda the next question, but before I do, I just want to know. So you are still in daylight savings time. I'm looking outside, it's dark. I wish I was where you are. It looks great. Do they have a nighttime background in Charlotte? They don't have a nighttime?
Well, I'm sure I could change the green screen. I have
but I like it. It just changed. I miss it.
I can turn down the brightness. Yeah.
No, it's great. I'm just joking. So it looks, your view is what I look out my window normally, but it's dark. It looks great. So Brenda, one of the things that Nick mentioned earlier was going to do due diligence and some other steps. We're going to talk about that in a few minutes. But I also mentioned the pre-approval process. Can you kind of talk to our attendees about what a pre-approval is and why that's important?
Sure. So a pre-approval is basically a loan officer like Matt or myself or Daniel taking a look at borrowers' income, their assets, and their credit. And when I say taking a look at, it means literally looking at it. So oftentimes you can go online and get a quick pre-qualification, and all that is taking the information that you inputted into the system and telling you, as long as you can prove everything you just said, then you can buy this or do that. We actually look at the information to make sure that what you've said actually is what you have provided to us, and it's verified. And then at that time, we can give you a pre-approval. And that pre-approval allows you to go out and shop for a home. And one of the main reasons I think that it's very important is because with a pre-approval, well, two reasons. One, you can't make an offer without a pre-approval. And if you're going to go out shopping and you find something, you're going to have to make an offer within 30 seconds or an hour. I mean, it has to be very quick. That's kind of the market that we're in. So that's number one. So you want to already have your pre-approval ready to go. But number two is, let's say you don't have a pre-approval and you decide to go out and shop, and you find a fantastic house and you find that it's either you can't afford it or you don't want to afford it, because when it's all said and done, this is what the payment is on that home. So we like to make sure that you are not only approved for what it is that you want to shop for, but two, you're comfortable with the payment of what you want to shop for. So we look at both of those pieces.
And Nick, when do you, maybe we should take a step back. And Nick, will you just kind of walk us through high level, kind of step by step, for a new homeowner, what should they expect? What's step number one? And then kind of walk us through in like a 1-minute overview what the rest of that looks like.
Yeah, generally speaking, just like Brenda said, you want to know going in what you are comfortable paying and what you can be approved for. So getting pre-approved, and that's why they put a big emphasis, Daniel, Matt, and Brenda on, getting the process started. And that's why, we have over $1,000 worth of credits just to start that process, right? And we're happy to do so because it's so important to just see where you are starting. And get a sense of what you can look at, and then the rest of the process is fairly simple. So getting pre-approved is where you want to start, and then the process is obviously finding the right home. Having an agent to represent you, hopefully, as we just discussed, right? And then when you make an offer, you go under contract. You're going to go over paperwork and do all these things. Let's say you're under contract now, you're going to go through, as I mentioned, due diligence, which is where you're going to investigate, have an inspector, third party, an appraiser, come and look at the house and tell you what's wrong with it or what it's worth and these things. And you are going to eventually get to closing, hopefully, where you will have an attorney that's going to certify everything and record a deed. In the process, generally speaking, that might have been another question that people oftentimes I get asked a lot, right, as an agent, which is how long does the whole process take? And really, guys, the great news is that if you guys start a process and get pre-approved, you can close on a home in under 30 days. If everything is pre-approved and you have all your paperwork and everything, it does not take 45, 60 days as the common misconception often is.
Well, and it's interesting, some of the really large institutions pictured behind you, we are hearing they're backed up and they're taking 45 and 60 days. Matt, if we've got someone pre-approved to go under contract here at TruLoan, what do we commit to?
Our usual expectation is a 21-day close. That's easy for us to meet. That's when we're just operating normally. There are special situations. Last week, we closed a loan in a very short turnaround time. And it was one of those institutions that's behind Nick that had a problem. And, we were able to solve that problem and close that loan. So look, I mean, we have an advantage, in terms of the service level that we provide here. And we also have an advantage in terms of the speed at which we can do things. That's one of the benefits of having a smaller, more agile boutique lender.
Matt, another question that came up from one of our attendees is, if I get pre-approved, pardon me, what does that do? What impact does having my credit pulled in that process have on my credit score? Can you kind of talk about that impact? And then actually, can you just give us a primer on credit scores?
Yeah, we every day see a lot of anxiety about credit scores and credit pulls that honestly shouldn't exist. We try to be open and honest with people about what the credit pull process is, actually how that's going to actually impact your score. And the answer to that is very little, if at any, impact to your score. A lot of times, technically, there's a reason why we, in the mortgage process have to pull a new score. There's reasons for that behind the scenes. And a lot of times we pull that new score, and the score is higher. So I think a lot of people have an idea that's incorrect, that if they pull their credit score to get pre-approved for a mortgage, that's going to negatively impact them. The reality is, this is why you have a credit score. The whole point of having this credit score, the number one reason would be to purchase a big giant purchase like this, the largest purchase that most people have in their life. When it comes to credit scoring, honestly, we always say that every situation is different, because every loan is different, and every person's life situation is different. But as a general rule, typically for conventional loans, your 30-year fix, 15-year fix, what most people are doing these days, you're going to need somewhere in the area of 680 and above score. Or is there a hard rule about it? No, it depends on a lot of different factors. And so that's why you need to sort of visit with us and see what you can do. When it comes to some of the government programs, they're going to be a floor around 620, sometimes even 580. The COVID crisis has turned this a little bit on edge, because when there's an economic crisis here in the United States, the first thing that adjusts, we learned from the mortgage collapse of 2008, is that mortgage market. And so it's not unusual for lenders to change the rules, and we've certainly been dealing with that. But if somebody's close, I'll give you a great example. Someone came to us and applied, and they had a 613 score. They really loved this house and wanted to go under contract. We worked with them. We got their score up to what we needed to, 620, and they went under contract, and we did all that within days. So I would say, come to us, talk to us about it, and don't bring in any sort of baggage about what your credit score you think it is and what that means. Like, we need to pull it, and we need to talk about the reality. And another thing I'll add, it would be great if the services that people have, like CreditWise and Credit Karma, and even the Equifax and the reporting, it would be great if they gave you accurate information. But in all honesty, since I poll and talk to people every day about this, it's not very accurate. My own personal situation, when I refinanced earlier this year, Credit Karma was 45 points off my score. So I wouldn't give that much weight. Most people know if they've got some credit hiccups in the past. That's when you really want to come in and talk to us. We need to know what we can do and what we can't.
So a couple takeaways I've got from that. Number one, don't be afraid to have your credit pulled to get pre-approved. The impact is minimal, and frankly, you can't get pre-approved without it. And on that note, sometimes people will also ask, if I want to shop, rates, does that mean it's going to keep on getting dinged? And I know I've asked you that before, and you've mentioned before that people can pull multiple mortgage reports within 2 weeks, where, like, if you're shopping for a car, you have multiple car companies pull for car lending, and the system looks at that and it only counts it as one inquiry for the purpose of credit score if it's done within a short period of time. Is that right?
Yes.
Yeah. Shopping for a mortgage is one of the reasons, there's a carve out for it. And this is one of the reasons why you have a credit score.
Right. So don't be afraid of that. Look at Credit Karma or Equifax or whatever service on your credit card just for a trend line. Are you going up or down? But don't look at it for your absolute score, because every creditor type has a different formulation, and what we're going to use is going to be different. So let's just figure out what it really is and don't guess.
Yes.
And sometimes people are pleasantly surprised. Sometimes they're disappointed, but let's just deal with reality and know what it is. So good advice.
I wanted to make a note about the pre-approval process. By the way, if we didn't say it, it is free. It doesn't cost anything.
That's right.
A little bit of time, but it doesn't cost any money. So
technically, we actually give you money,
right,
because when you get pre-approved from this event, we are giving you $500 and a gift card.
It's a income source.
Yeah, right.
You cannot use for.
You could be a professional borrower.
I love that.
We've got some chat questions really quick.
We do. So let me ask you, how long is that pre-approval good? Someone says, if I get pre-approved now, but I don't buy till next year, Matt, talk about that. How long is it good? Listen,
the reality is that your actual credit report that we're using for the loan has an expiration date, and that's a few months.
It's 4 months, right?
Yeah. So, but again, don't worry about that. Number two, if something changes, the way we view it is if something changes in your financial situation, please let us know. But if it doesn't, we've got a number of people that have been on their same job. They know the plan. They know what their save goal is for the down payment. We set them out, last year to start looking at houses. This is a very tough market. You need to be patient. It is brutally competitive. And so the time frame is longer for everybody. So don't worry about the pre-approval expiring unless you lose your job, you have a change in income, you're changing careers, anything like that, or you decide that you want to go out and get a brand new $60,000 BMW. We need to know about that because that massively impacts what you can and can't do. So, but if your situation stays, the same, we don't really put an expiration on it. We want to just keep having that conversation. Hey, are we sticking to the plan? And most of our clients that are out there searching over the long term, they know what the plan is because we've gone over it and they're sticking to the plan.
Hey, Matt, I was going to touch on what Matt just said, because this is a common thing that we as realtors get asked about us a lot. Matt just said stick to the plan, right? He said stick to the plan, and I always preach that, guys, stick to the plan, which also means that when you're under contract, don't go then, once you're under contract, go buy that $60,000 car, because that's going to be that will majorly affect your capability to purchase a home. So stick to the plan. Don't
buy the car after the house.
Car after the house.
Yes.
Here's a great example, and it doesn't have to be a $60,000 car. You're buying a first-time house, and this is one of the things that we communicate with somebody. So let's say that we're using real numbers, $200,000 first-time house, and we've got them qualified on their income, but they barely qualify. Things are tight. We want to make sure that we protect that. We want you to get in that house. You're comfortable with it. Here's the situation. You want to go and buy that store, spend $3,000 in getting furniture to furnish that house 2 weeks ahead of closing. Do not do that. We will wait until after closing, and then you can get the furniture that you need.
It's okay.
One day after. Just we go over all those best case practices.
Yes. We got a question from an audience member, but before we do, I want to ask Nick something, because I heard Brenda and Matt both talk about this tight market, right? Tell us about the market, Nick. Like, we've made a lot of comments about it's competitive to buy a house. So walk us through that. What does it look like, and how do you provide your clients a competitive advantage to get the house that they want in this market?
Well, I'll tell you the first reason why you guys are in great hands tonight, because you just mentioned competitive advantage. Daniel mentions competitive advantage. What you want in your corner, again, we talk about representation. You want a team in your corner, and that goes beyond just me as the agent. I would need to rely on, on the lending side, a really awesome team that's going to make sure that we're in the right place before we even start that process. So if you guys get pre-approved, that gives me all the ammunition as the agent to say, okay, when we find the right house, it is going to be a tight market. There's a lot of buyers. There's not a lot of inventory. So it is still a seller's market that is turning, right? It's slowly turning to a buyer's market at kind of the higher price points, because there's less buyers at the higher price points. So that is sort of turning. But anything under 400,000 and down is a very competitive market. You're going to have multiple offers on almost every single home. So you have competition out there. But I'll tell you, there are people that try to make offers and go and buy a home, and they're not quite there on the pre-approval side, or maybe they're not ready. They haven't gotten the communication from their team, from their agent, from their lender to really understand and feel comfortable with the process. So they're not ready to go. If that stuff can be taken care of beforehand, and you have the right communication, the right team in place, you have an advantage, because when the right home hits the market, I just went under contract 2 days ago and had a listing go under contract in 1 day with multiple offers. But the one I went under contract 2 days ago with my buyers, they were able to, in multiple offers, sign right away. I sent over the pre-approval. We got it. We went, showed the house. I had the offer in the agent's hands in an hour, and we were under contract. And that comes from their preparedness and the communication. They were ready to go. It's the perfect house for them.
Matt, tell me, I've heard at least multiple times, tell me if I'm wrong, about calls you've gotten from listing agents asking about the quality of the pre-approval because they were comparing multiple bids, deciding which deal to take. Tell the audience about the video pre-approvals we do for competitive offers and walk us through how that interaction with that listing agent went to give our buyers that edge to win the bid.
So it's a super common thing in this market that you're trying to gain every single advantage that you can to prospective sellers. And having a local boutique lender in your corner that is accessible, to be honest with you, nights and weekends and anytime that you need, is a huge advantage. So when someone sees our approval cert that we send out and it has a local lender presence, and B, it has, you know, one of the founders of the company has signed that letter stating that we've reviewed the income and assets of this borrower and we can move fast. The big advantage comes when they call us, because when they call us, you know, I'm telling them, without sharing any private information, I'm telling them, hey, this is actually what we've done with this client. We've got a great plan. They're ready to close in 21 days. Whatever you need, I anticipate no issues along the way. What other questions do you have? And we sit there and have a conversation. And I'm basically, you know, I'm bestowing the virtues of the buyer onto the seller to try to win that deal. And usually when I get a call, that's going to contract, and we're writing that contract in the next 24 hours. That's why they're calling me. They want to make sure everything's good. The other thing I'll point out that speaks to this is it's a real challenge in this market. If you're dealing with a call center in Las Vegas, you may have found online, or you saw a Super Bowl ad and you want to apply on your iPhone. The problem with that situation in this market is you won't be able to reach that person. That person works in a giant call center with 100 other people, and you know, you don't have their access to them. In fact, we had a situation the other day where somebody came to me and was, well, I have to schedule an appointment with my loan officer to speak over the phone 4 days from now. Can I just get going with you guys and close in 21 days? And we were absolutely, and we got them a better rate too. So, I mean, listen, I can tell you, we're giving you $1,000 for everybody that's here between us and Nick. You've got a huge leg up on the competition already if you sort of come visit us and execute the plan.
Brenda, we've got a question I'd like you to address. Chris wants to know, look, if you've got zero savings, but great credit score, how would I go about getting a pre-approval when I've got the income, the credit, but I don't have the down payment? What options do we have? So just talk about what the different down payments are, and then what no down payment options are available as well.
Okay, so I'm gonna also actually answer the question, which is, if you have a great credit score, but you haven't secured any savings or assets yet, we don't see that as a negative necessarily. That we wouldn't look at it. If you don't have a down payment, you may not qualify for some programs, but it doesn't make you look differently. It doesn't take away from your great credit score. Let me just put it that way. The down payment options we have are, we have a couple of down payment options that we can use up in the city of Concord and the city of Charlotte. If the property is located in those two areas. We also
Special first time
down payment assistance.
Only. Also, if you go out in what's called the rural area, now it doesn't mean you have to buy a farm. It just means you have to be in a certain geographical location to purchase a home using a USDA loan. That loan requires zero down payment as well. If you happen to be a veteran, that loan program also requires no down payment. So there are several loan programs that require no down payment. If you have a credit score, you can qualify for as little. If your credit score is above 700, you're going to qualify for as little as 3% down on a conventional loan. If your credit score is perhaps less than 700 or less than 680, you're qualified for 3.5% down with an FHA loan. So you can get in with a 0 down payment or even a small down payment. So there are many different possibilities, but having no savings will not necessarily take away from your great credit and your great income. It just limits the amount of loan programs you may qualify for. But you can get a gift. You can get a gift
Right.
for your down payment, and there you go. You don't have, it doesn't have to be your money. You can get a gift.
And you can also, if you have a 401k, you can, some people will borrow again from themselves on their 401k, right? So there's a lot of different options. And even
The stock
when,
market's so high, now is a pretty good time to borrow money from yourself,
right.
actually.
And the other thing is we've also seen clients that say, look, I'm going to buy and I'm going to close. Like I recall, Brenda, one deal that I worked on with you back in June. The lady bought and she knew she was going to save money from every paycheck. So she knew exactly how much for a price range she needed, down to the penny. She knew how much she could save from every check. And we scheduled the closing the day after she got paid. That would give her a last $600 of savings for it.
Yes.
And it worked out. She closed. So, I mean, you know, there's a lot of ways to approach it.
Yes, there are.
And some of them are 0 down payment. Some are 3, 3.5, 5, or as much as you want. So we would encourage anyone who is gainfully employed, has reasonably good credit and interested in buying a house to have a discussion. And it goes back to what Nick was saying earlier and Matt was saying, is you just create a plan and you know your options.
And on that topic, Daniel, we've got a question about debt to income. There's a side discussion going on about Teslas you might want to chime in on, but
Oh, I'm already on the Tesla discussion.
we have a question about debt to income. And listen, debt to income is one of the big criteria that we look at when we're putting together the pre-approval. And honestly, that's really the great example, because we have all the rules of what we have to use and what we can't. And there's a whole system for calculating whatever your income source is. All the more reason to know exactly what your number is. And by the way, that changes with the purchase price and the taxes and everything going on with the house. We need to look at those numbers in detail. That's all the more reason to come see us and have a full pre-approval, because you know, if you want to dive into those numbers and learn a lot about your situation and what you qualify for, then by all means, you need to come visit us.
Yeah, for sure. For sure.
Speaking of debt to income, I think it's a good segue into student loans.
Can you see what I highlighted, student loan? So that was my next question. Yeah, so talk to us, because we have, you know, look, millennials got some student loans, right? So talk to us about that, because I know that's probably, when we're doing these in person, the number one fear that people have. I don't know if I afford it because I'm saddled with these student debts. And student debt is a real thing. I mean, it's a real issue as a national issue, right? But talk about that in context of getting a mortgage, and how many clients have we had over the last couple of years that ultimately couldn't buy a house because of your student loans. Talk to us about that.
Okay, they can, so ultimately, the amount of buyers that I have pre-qualified in the last year that could not buy a house because of their student loans has been so far 0.
Me too.
So now and I'm going to tell you, and we may be in this small little window of opportunity, if you will, because right now student loans are in forbearance. Now that doesn't mean we don't get to count them because you're not paying for them right now. It does mean we get to look at them differently, and we actually have 2 or 3 different options that we may or may not have if those student loans were reporting their monthly amount. So now we've got this small little time frame that has allowed us to kind of, you know, use all of our options to qualify folks based on the best path for their situation with their student loans. So the only thing I can tell you is apply. Let's talk about it. Let's have a look at it, but don't be afraid of it, especially now before December, unless we get another reprieve, which we might.
You're on mute, Danny.
Sorry. I'm having some. Okay, so basically, student loans, lots of different options, kind of like the down payment thing. Matt, how many clients have you had to turn down because of student debt over the last year? Zero.
Zero. And I've got an even better example. I have a young lady. She works in a hourly job where she gets paid, a living wage, but, I would not say that she's not making a high salary job. She has over $300,000 in student loan debt. It's on an income-based payment plan. They're buying a house in 2 weeks. So the guidelines are there to make sense. The guidelines are there to deal with student loans because such a large percentage of the population, particularly the age group, that we're talking about, millennials, have those student debt. So we need to know what your situation is and, not be afraid of it. We need to confront it.
Okay, that's great. That's really, really good to know. On that note, we talked about down payments, and some of our audience did select the 20% down payment. Can you talk to us, Matt, about when do we not need 20%? I know that involves mortgage insurance, and just kind of talk to us about what it means, mortgage insurance, and how much we should be focused on that positively or negatively.
So just like the credit pulls, we always suggest to people to not be afraid of mortgage insurance because of a couple of good reasons. Number one, mortgage insurance is what allows you to buy a house. You're buying a house anytime you don't have at least 20% down, you are going to have mortgage insurance in some form or the other, most likely. There are some exceptions, but most likely. Number two, that financial instrument is really good for you because it allows you to start being a homeowner and get that appreciation. It also allows you to buy the new house that you love. So it's a really good deal. Mortgage insurance has never been more affordable than it is right now. It's transitioned in recent years to a risk-based pricing. So if your credit score is good, you get a little bit better pricing as you're putting more and more down payment down, your rates go down. But let me give you a real world example. We had a young lady that came to one of our events, just like this. She came in and she had done the right things. She had saved up 20%. She had targeted a certain amount she wanted to spend. She saved that up. When I walked her through the numbers, okay, well, we'll be emptying all your savings and using it as a down payment, or you can pay this in mortgage insurance. And that figure was $35 per month or something like that, 35 to 50, something like that. And hold on to tens of thousands of dollars in your savings account. She said, oh yeah, I'll take that. Because if there's anything that we've learned, in the COVID crisis, is that having savings in the bank really helps you sleep at night. And so for that reason, we tell people, let's look at your situation. Let's find out what your best path to that is. And don't be afraid of it. You got to remember, that's what, and it, just like a mortgage, you're paying the interest on the mortgage. That's a good thing because number one, rates are the lowest they've ever been. Your buying power is the highest it's ever been. And that interest that you're paying on that allows you to become a homeowner and to experience all that appreciation of this hot market and to be the person that is the owner of that asset that's appreciating, not just the person who's paying rent out every month and saying bye-bye to that money forever.
Hey, Matt, if I may, I just wanted to add to what you just said, because I love your response and what you were bringing up about real numbers like mortgage insurance. And generally speaking, you'll hear realtors sometimes and people in general overgeneralize things. And then they kind of become, misconceptions or stereotypes because, people will get, as a buyer, you might say, well, if I heard that if I don't pay 20% down, I got to pay PMI, I got to pay mortgage insurance. But when Matt breaks it down and says, look, $35 a month, like let's talk real numbers, right? You want a team that's going to be real to you and just give it to you straight. And so that's why you have these conversations. If $35, as you said, a month might be stopping you from almost $50,000, that question said over 3 years of wealth. If $35 a month is going to stop you from building that wealth, I think I would take that deal every single time, wouldn't I? Right? Wouldn't you?
Right.
Yeah, you've got to realize that financial instrument called mortgage insurance is your friend. That's what's enabling you, just like the mortgage is enabling you to get that house. You're on mute again, Daniel.
Nick, talk to us about a couple things. You know, if you buy a house in a lot of older neighborhoods closer into town, they're not going to have a homeowners association. You get into some of the newer developed neighborhoods that have more amenities,
Sure.
they're going to have, and some older ones that have amenities, they're going to have homeowners associations. Talk to us a little bit about that. What does that mean to have a homeowners association, and what is the range of costs, and what do they cover?
Yeah, there's a great debate on homeowners associations and what they bring and the value and all that good stuff. I always look at it like this, right? So in principle, the idea of a homeowners association is to provide protections and values to the community and say, hey, look, you know, we have a certain standard that we want to try to set. Here's amenities that we have that we want to try to provide for the community, and they, you know, they have expenses like, let's keep, you know, the sidewalks maintained and have, you know, different amenities maintained and things like that. And so a homeowners association in principle is for those things. So as you mentioned, Daniel, especially in South End or, you know, condominiums, townhomes, they'll have an association set up for a lot of times maintenance of different common areas, amenities, things like that. Some of the older communities, you know, might not have a homeowners association, but they might still be subject to certain covenants and restrictions. And again, those are put in place in principle to protect you as the homeowner and the general community as a whole. And so again, just like, you know, Matt was saying with the insurance, I mean, it's nothing to be scared about. It's good to know, you know, and understand. And that's always what I try to communicate. You know, since I've been doing real estate, what I've learned is that this is, generally speaking, a lot of people will view this as a big financial decision, and it's a stressful and kind of pressure. My job mainly, and it's all of our jobs here as a team, is to make it as de-stressed as possible and to really try to provide as much clarity and communication. And so it's, you know, again, homeowners associations, there's a lot, you know, there's a couple of schools of thoughts of whether, you know, they should even have them and things like that. The general principle is some communities do, some communities don't. It's nothing to be scared of, but it's something to be aware of. And if it does have one, understand what are the rules and what it does for you, because there are benefits as well.
Because a lot of times they can be as little as $10 a month just for the nice little entrance sign. Sometimes it could be $50 or $60 a month for some common areas. Sometimes there's a community pool, you know, we're talking about single family. But you know what? I asked about single family and then you touched on condos. So let's just jump to that. When you buy a condominium or a townhouse, because you touched on South End, and that's really what we see there, right? Very popular. What are the different considerations of buying a single family home versus a condominium? And let's use that classic South End area as an example. You kind of use that prototype. I mean, what are you getting differently? You got that fee, that HOA fee. What does it cover from a maintenance perspective as a new owner that's used to having a landlord to call to fix stuff? You know, talk to us about condominium life and buying. Yeah,
South End is a great area. I'm there all the time and I sell a lot in South End. And so there are plenty of advantages for, you know, a different lifestyle fit, right? For a condominium, townhome versus a single family. And when in regards specifically to HOAs, you know, homeowners association, on a townhome, for example, right? You may, you know, the maintenance of the exterior of the building may be covered by you know, the homeowners, you know, homeowners association fee every month, you know, sidewalks, the streets, all this stuff that is maintenance may be maintained. You may also have, as you mentioned, like a pool or something like that in a townhome community or in a condominium, where in a condominium, you own everything inside the walls, right? The townhome, you own everything, you know, kind of above your lot, you know, including the townhome and including the walls. So the difference is that the HOAs in general, they cover what they cover, but they vary a lot. And that's why it's so important to have, you know, that stuff dug up and do your research beforehand. So, you know, if you are working with somebody, you know, like myself, who sells a lot in South End, is familiar with a lot of those, it's another big advantage. Kind of what Matt was saying earlier, when you have, you know, a local boutique, people that are in the area. You know, Charlotte is my home. I'm born and raised here. This is a town I love. So I am very familiar with all those areas. And so you get to know certain communities You know, I just sold a townhome in South Village, and beautiful community built by Pulte Homes, great builder. And they do things a little bit differently with their homeowner association. You know, there's a lot lower association fee, but I know now that twice a year they do maintenance on the exterior. They also cover termites and termite bonds with their homeowner association. So they'll actually go replace termite traps around the entire, and that's included in the fees. So there are different things that are offered by different associations, but it's important to know and research that beforehand.
So I think if you don't mind me just kind of summarizing that, when you're buying a single family home, you're responsible for all the maintenance, outside, inside, the land, the yard, everything. When you buy a townhome, or specifically even just talking about condos, because that's what we mainly see more of, you are buying inside your condominium, and the association fee that you pay every month covers all the maintenance of the building, the yard, the exterior, the hallways, all that's covered through that, which makes it a little more turnkey. It's a little more similar to being a renter, in that you're paying your landlord and they cover all your maintenance. And when you buy a condo, you pay that fee every month, and everything outside of what you live in is covered. So then owning a condo, you're really responsible for your just inside the space. So if you've got an appliance that goes bad, or something like that, or your own plumbing, your toilet breaks, that's something you're going to fix. But besides that, once you step out to your front door, all that's covered through the association. Would that be a reasonable way to summarize it?
Yeah, aside from the inside maintenance, like you said, if your toilet breaks, things break inside, you are going to be responsible for those things. You own that stuff. But I always liken it to I mean, there are benefits, right? To not having to deal with that exterior stuff. It's pretty much.
Oh, absolutely. I think for a lot of people, that's a good transition, right?
It's all the benefits of renting, except that you're building wealth.
That's right? A great way to say it. I like that. Yeah, that's really good. I like that.
You own it. You own it. That's a big difference.
Yeah. Now, folks, before we go on to our next question, I want to remind you, if you have questions, please pop them into the chat or in the Q&A. And we'll cover a couple of other items here and check for questions again before we wrap up. But please, we want to make sure that we're answering your specific questions. So please put them in there. Earlier, you also mentioned inspections, Nick. And so just talk to us just briefly, like, you mentioned due diligence and inspections. And I just want our audience to know, when they go and they find a house that they think that they love, what that due diligence does to protect them, what that period does, and it gives them an opportunity to get inspections, and what opportunities they have to back out if they uncover things they don't like. Just kind of give us an overview of that.
Yes, great question. So great point. So in North Carolina, you actually have two deposits that you're going to write when you make an offer. There's a due diligence deposit, and then there's an earnest money deposit. Now, the reason why this is a good thing, okay, because there's always questions over this, but the reason why this is a good thing to have two deposits is because a due diligence deposit is non-refundable. That goes straight to the seller, but that's the only non-refundable deposit. The earnest money deposit goes and is held by a third party, by an attorney in escrow, and that's held by them. And if you decide to back out because you find something on an inspection, you can actually get that money back. And so there are certain states where there's only one deposit and it's non-refundable. And so basically, if you back out, you're losing all your money. So in North Carolina, by splitting that money, you're actually not risking as much. But to answer your question, Daniel, your due diligence period and the inspection period, what that allows you to do is you're going to be, and I would highly recommend everybody on every home, got to do it. Get an inspection by a third party, by an inspector, and they'll come in, and what they will do is do a full, thorough inspection of the entire home. I work with some great inspectors, and like seriously, sometimes on the reports, they'll be like 90 pages long, and they'll say the third spindle on the stairway going up to the third floor was a little bit loose. Like, that is the level of detail they will get into to find everything that could potentially be problematic in the home or is not up to code. And the reason why that is so important, again, as you mentioned, Daniel, is that if there is something that comes up, you have this period where you now can negotiate. And this is where a buyer's agent, like I mentioned earlier, really earns their stripes, right, is in the negotiation period. And I've had certain instances where I've been able to negotiate the price down tens of thousands of dollars for my clients on their behalf. And I just had a client back in January of this year who we went under contract. We had an inspector go out there. We had a couple of other contractors go out there, make some quotes based on the report that the inspector made. And some of the contractors came out and said, hey, you know, there could be $10,000 to $15,000 worth of repairs needed in the crawl space. We might need to actually replace all the drainage. There's some water issues down there. But what happened is I was able to negotiate. I got them $12,000 reduction in the price. And then when it was all said and done, he had his contractor go in there and actually do the work after he owned the home. And he calls me back a couple months later. He says, Nick, he said, I got to tell you, you know, I actually went and we had a couple different options. He said 15,000 was like the high end. He's like, I only spent about $5,000. So you saved me about $7,000 in that negotiation.
No, but Nick, let me ask if that story gone a little differently. Let's say your buyers, when they found out about that water, they're like, I want nothing to do with that.
Sure.
They could have backed out. They would not have lost their earnest money deposit. They may have put a few $100s down for due diligence to reserve the house off the market to give them the opportunity to review all these things. And that's all the money they would have been out. They could have moved on and found a different house. Is that right?
Yeah. And again, the second reason why, and thank you for bringing that up, the second reason why that couple $100 for due diligence is also so important is because of what you just said, which is you're reserving the home. In North Carolina, the sellers can never back out of a contract. Okay. You as a buyer, once you are under contract, you have that signed, executed contract from the seller. They have signed off and you have delivered that due diligence check of a couple $100, right? Normally speaking, to the seller, and they've accepted it. The seller, so let's say I offered we have a client, we offered $250,000 for the house. We're under contract, they accept. Even if that seller gets $1 million offer from another buyer, that seller cannot just say, oh, you know what? We got a higher offer. We're going to go with them. The reason being because you delivered that check and you were under contract and you could sue that seller. And so that can never happen. The seller cannot back out. So that due diligence, as Matt would say, protects you as your friend, right? It is a very good thing for you because it allows you that period to inspect. And if you were to back out, you're only risking that money. But if you want to go forward, even if the seller was getting other offers, they cannot, kind of skip you in line and take the next offer, even if it's better.
Okay, no, I appreciate that. You know, I want to clarify another thing. You mentioned during that process, you mentioned deposit's going to be held by an attorney, got to find an inspector. Your client doesn't, the buyer doesn't have to find an attorney and inspector. That's stuff that you handle, right? You and your firm, it's turnkey. It's not like they're going to work with you, they're going to work with us. And then between us, all these ancillary players are just going to magically appear and happen on their behalf. Is that right?
So can you kind of explain? So do you want me to give you a scenario or?
No, I just want to clarify that as a new home buyer, you mentioned the deposits can be held by an attorney. They don't have to go pay a deposit for an attorney to hold their deposit. Like,
oh yeah. Oh, okay, I understand now. So
easy. Yeah. It's in other words, I didn't want it to seem like they have to go find an attorney. They have to go search for an inspector. Nick and his team are going to make sure all that happens. It's just part of the process.
Yeah, without a doubt, exactly. I mean, that's another reason why you have a team. I work with some amazing attorneys, inspectors, and vendors, contractors. And on your side as well, they don't have to go find an appraiser or, an underwriter, right? Like, they don't have to go figure out that whole process. The idea is that, you're working with us, you're gonna work with our team. I have a team as well. I have a coordinator. I have, basically anybody that you need for the entire process will be laid out for you, and you have plenty of options. And again, like you mentioned, the whole process, if you have the plan, is communicated correctly, which is always my goal. I always aim to set the expectation. That's something that I appreciate about TruLoan as well. Expectation is set up front. You'll know what to expect. And then when we hit those expectations and those results, there's no surprise, right?
So we have a couple questions. One is, if I wanted to buy a home that is a short sale or a foreclosure, not that I think there's that many out there right now, but there are. can I get a mortgage on that? And am I allowed to have a due diligence period? So let's start first with Nick on the due diligence. When you're buying a short sale or foreclosure, do they still have the same opportunities to go through under due diligence, or is it just a guaranteed sale? Then we'll pivot to Matt or Brenda to talk about the lending aspects.
Yeah, when it gets to short sales and foreclosures, you're going to run through the process of, through the banks essentially, and you have to go through a couple extra rounds of basically, you will have time. Just to answer your question, you do have time to inspect, and you can back out. And you can always back out as a buyer on a short sale if something comes up. Generally speaking, though, most people look at a foreclosure or short sale. They're going to get a very reduced price of what we would call market value. And so generally speaking, if you find something, it's, you as the buyer are going to be told by the seller, which in this case would be the bank, that generally speaking, you're going to take it as is. And so, most of the negotiation will happen around the price. But there is a period to inspect.
In other words, you have the opportunity to inspect. Usually they won't repair. You just have the opportunity to back out or decide to buy, is whatever.
Exactly. Yeah.
And then do you have an opportunity to set up in your search. So people get a pre-approval, right? And then you're going to then know the price range, and you're going to set our folks here on this up on an email campaign that the second a house that meets their search parameters for neighborhood, type of home, bedroom size, and price point. As soon as those come on the market, they're going to get an email to notify them, right?
Yeah.
Do you have the ability, if someone wanted to search specifically for foreclosures and short sales, if they're tagged as that, you can create that search so that they will be presented all those specific properties. Is that accurate?
Yeah, so I see the question there in the chat, right, about those listings. You're absolutely right. So as a realtor, I have a direct feed to the MLS. So within minutes of something hitting the MLS, including foreclosures, short sales, things of that nature, you will be notified right away within just a few minutes. And I actually work with a lot of investors as well that are privy to that information because they work with me. So so as Matt I think said earlier about Credit Karma and all those things, right? I would feel the same way about Zillow. When you go look at Realtor.com, you're
Delayed.
not the most accurate. It's diluted. It's not accurate. And you're going to find that oftentimes that information is very outdated, because I have clients all the time that say, Nick, check out this property I found on Zillow. And I'll go look it up. I'm like, that was sold 10 years ago. I don't know why it's still on market on Zillow.
Or even, listen, sometimes it says it's new on the market, but then because of the way they get the data, it'll come up today and it went up for sale yesterday and it sold last night.
Or even better yet too, sometimes because of how it updates with Zillow and Realtor, where they pull their data, sometimes the price will be very outdated. So like you might say, well, this house is at 400,000, but they might have made a $20,000 drop in the last week, and it doesn't reflect on there.
It just doesn't update, and that's why, folks, there's really, listen, I use Zillow all the time. It's a great resource to look for stuff. I'm like, oh, I want to see what the taxes are on a house. It's not always accurate, but usually that's accurate, and it's easier to find than going to the tax website. I mean, I use it for a lot of stuff. If I was looking to buy a house, I would not use Zillow to inform me of what the newest houses are on the market, because of exactly what we're talking about, because it's an interface and there's delays and glitches. And so you want to work with your realtor to get that. And if you're getting a feed from your realtor in real time and you're not seeing what you want, that's where you have a discussion. Nick, this isn't working for me. I'm not seeing the houses I'm looking for. Why not? And then you dig in. Okay, well, maybe we need to expand their parameters. Maybe we didn't narrow them. Maybe something has to change about the parameters. But at least you know you're getting the information in real time and it's accurate information, and you just have to change your parameters. So another.
I didn't want to make one comment about foreclosures specifically on Zillow. It posts them, and because they go to the site, if a foreclosure has been filed, it doesn't mean that it's over and now a bank owns it or whatever. More than likely, the people are still working through that, and it could be months before that house hits the market. So it's really not reliable. I mean,
that's actually a really good point. Where Nick, if he has a listings foreclosure, that means it's gone through foreclosure and it's on the market to be sold.
There, yeah.
Zillow kind of has this thing where they're like, hey, this might become a foreclosure is basically what it says.
Yes.
Yeah.
Yeah, and yes, so that's actually very, very, very good advice, Brenda. So work with Nick on that. He can help you find those. Question, Brenda, that came up is, what are the costs to buy a house? So talk to us about closing costs.
So closing costs are typically between, I would say 3,400, 3,800, something like that. And that includes, it sounds like a lot, but that includes our cost, that includes the attorney's cost, that includes the cost of the appraisal, which, depending on, if you come with us, that may or may not be credited back to you. That also includes, some other third-party vendors like flood certs and credit reports, but that's the total.
That's a pretty good range, right?
Yeah.
Now, another thing they're going to have in addition to closing costs is, let's just talk about Matt. Can you talk about escrows and what that means when you're making a mortgage payment? Because it's different than renting, right? So now you got taxes and insurance. Just walk us through that and how that's dealt with to not have surprise bills.
Sure. When a mortgage lender gives you, let's say, hundreds of thousands of dollars to help you purchase this house, they want to make sure that two very important bills are paid. Those bills are the tax bill on the property that's due yearly, and they want to make sure that the homeowner's insurance is paid, because if the house burns down and we don't have insurance on it, then everybody loses everything. So those are so important that we're going to set up escrow accounts to make sure that you're paying those on a monthly basis, so that when the bills are due, wherever they are in the cycle for the year, that the money is already there. As a homeowner myself and as a borrower, I love it because it's just built into my payment. I don't have to worry about those two bills. And I wish I could do that some way with my car property tax. I get that bill and it's annoying. I have to pay it. And I wish
I never thought about that.
Yeah, I wish I could escrow for that too and pay it somewhere else. But
that's a whole
that's
business.
how
I love
escrow
that.
works. But when you're purchasing a house, you have to pay for that first year's homeowner's insurance in advance. You also have to have a couple of months cushions of the premium tucked away, and you have a couple of months cushions of the taxes put away. And these are called prepaid items. They're really not costs. They're not blanketed into that figure that Brenda gave. They're not costs. They're things that you're going to have to pay for as being a homeowner anyway. And that's just sort of the accounting of it. But it can be substantial. And you want to make sure you're factoring that in when you sit down with us and you come up with your plan. We are going to go into the numbers in detail so that there won't be any surprises on that.
Sure, because there's different tax rates depending on whether you're looking in the city of Charlotte, or if you're going to Matthews or Union County.
Rock Hill.
So we're going to look at that. We're going to estimate what that is. So then you're going to have that number from Brenda that she talked about, that 34, 38, 3,900. And then we're going to figure out what these prepaids are. But then, so that might be another 1,200. It could be 2,000, depending on, what neighborhood and price point. But then to what Matt's point was a minute ago, when you make your monthly payment is going to include the principal payment that you're making towards principal every month and the interest. Plus, it's going to include your escrows, which means 1/12 of your annual tax bill, 1/12 of your annual insurance bill. So you're going to have one big, lump sum payment. But when you make that every month, that's basically going into a piggy bank being saved by the lender to pay those bills for you at the end of the year when they come due. So you don't have those surprises, which I love Matt's idea. I wish I could do that with my car payment. That would be great.
Yeah, and we've actually got a question about what car property tax is. It's the same thing. When you own a property here in Mecklenburg County, for example, you have to pay property tax on that. The same thing's true for owning a car in North Carolina. You have to pay property tax on that car. If you're not getting the bill, then somebody's paying it for you.
It's that money you have to send in when you get your registration every year.
And the other question we've got is, what is a car property tax? Someone says. All right, so you do, and it goes to that. But it's a good question because they changed it a couple years ago. It used to be you would get a bill from the county. Now it goes to the DMV. When you renew your tax, you have to pay it. But it's actually a property tax for owning a car.
But it's still Mecklenburg County property tax.
It is. But listen, here's another question. Someone said, what if I've got a lease and I find a house let's say in 2 months, but I've still got 6 months left on my lease. Matt, we've seen people break their lease, and can you talk about the typical clauses we see? But actually, it's a great opportunity to talk about the timing of your first mortgage payment.
Yeah, there's a couple things there. Listen, sometimes, you got to look at the long-term plan in life, and let's say that your lease, it costs $2,000 to break it, but you're going to, get $80,000 in equity over the next, 10 years because of that decision. Sometimes the house is more important. That's the first statement I'll say. Second statement I'll say is call your, whoever has your lease and find out the exact terms, just so you know. The
A
third
lot
thing
of
I'll
them
say
have
is-
very defined terms, and a lot of it's like you got to give a month notice, and it's 2 months rent. So
Yeah, call them and find out the exact terms. Number three thing I'll say is, that is something that, in a normal market, you can, if you need that, you can negotiate that for the sellers to pay. We've got a great team right here that can help you, overcome whatever the obstacle is. For some people, it might be a lease that they've signed. For other people, it might be the amount they've got saved up. For other people, it might be credit. Whatever your situation is, we've seen all the obstacles, and you have a great team here to set you up with that, to help you with that. What the other point that Daniel was alluding to was there's something that happens when you transition from being a renter to being a homeowner.
Yeah.
And it's important. It really does play a role in the whole process. When you pay your November 1 rent, you are paying for the ability to rent that place for the month of November. You're paying into the future. When you pay your November 1 mortgage payment, you are paying for October's interest. You pay in arrears, it's called. The reason why that's important is because let's say that you end up timing it perfectly, and you are purchasing a house 2 days from now, and you have a lease in your apartment lease that takes you through to the end of November. So now you've got a couple of weeks to move and get into the new house. You will actually not have a mortgage payment that first month. It takes us a little while to set up the loan and get the loan really set up so that you can make payments. If you're closing, later this week on a house, your first payment is going to be due January 1st. Well, if you have a lease through November, that means that you don't have a lease or a mortgage payment in December. And the reason that's important is because that means there's a little bit of extra money from your paycheck that can go towards moving expenses, that can go towards closing costs, that can go towards down payment. And it's a real break, because a lot of times people are dumping their savings account in to purchase that house. And, it's just one of them. That's a pro level tip, the kind of stuff that you're going to get from us on how to structure your loan and the timing of it. And on that topic, I will say, and Nick really alluded to it earlier, talking about the vendors and talking about the process when you go from contract to close. That process is a symphony of all these things that need to happen. When you have a good team behind you, you really do have the advantage of having all those vendors, but we manage all that behind the scenes so that you can focus on the things that you need to do, working, paying your bills, going through the process, getting us what we need. And we work out all this kind of stuff behind the scenes and give you all these little money saving tips along the way to help you get in that house.
That's great, Matt. Thank you for going through that with us. We're coming up on our Brenda.
Yeah, I was just gonna go back to, and not that I'm pushing buying foreclosures and short sales, but she asked a question that we didn't answer, and I think it would also go for other homes also. Oftentimes when you buy a foreclosure, they're not in the greatest shape. And so when you buy a foreclosure from a bank, they are not going to do any repairs, like Nick said. Like you're buying it, and that's what buying something as is means. You can do an inspection, but they're selling it as is. It doesn't matter what you find, they're not going to fix anything. And you're not going to be able to negotiate any repairs. So when you're going out to look for that, one thing that's going to happen on our end is for us to lend on that home, it has to be in good repair. Unless you get a different type of loan where you're going to use some money to repair it, and then we're going to loan on that in loan. So if you're using just regular conventional or government financing to buy a home, the home has to be in good enough shape for us to lend on.
And that's not to say all foreclosures aren't.
Right, but
Sometimes they're bad.
yeah, but I wanted to make that point on, because it was a good segue into making a point about so when we send an appraiser out, because you send an inspector and they look at things, and then we send an appraiser, and the appraiser will give us an appraisal, and the appraisal will either be as is or subject to. And subject to means there are repairs that have to be made before we can close the loan. So I just
And
want to
most of the time, those are related to health and safety things, but
Yes.
not always, so in other words, if it's ugly, it's got shag carpet and nasty, like old appliances, no big deal.
Okay, no big deal.
But if, it's got a leak in the roof and it's got, the,
Open walls.
well, things like that, electrical outlets that are open with wires out of them, that's a safety and health thing that would have to be repaired. So it's a great point.
Hey, Daniel, I've closed on some wacky looking homes with some investors that do flips and remodels, and they still close.
Well, yeah, but they're using different financing on that. So, yeah.
I will jump in here and say, the person that was asking the question, this is a first-time homebuyer seminar, and it's not that common to see first-time homebuyers purchasing foreclosures and short sales. So what the question may be asking is like, well, how can I get a value in this market? And honestly, that's a challenge in this market, because as people that we know that are out there searching and that we've pre-approved, like just getting a house is sometimes the challenge in this market right now, because the market is hot. And we've mentioned investors a couple of times in this discussion, but you've got to understand that the rest of the country views Charlotte as one of the hot markets. And so if we have a number of investors that are outside, that live in completely different states, that are buying up property in the Charlotte area, and this is a well-known thing. So you're competing with these cash buyers, the buyers that have, deep pockets to flip a house, maybe fix it up, buy cash, get it quick, if it's foreclosed. So I would say that, buying a foreclosure or short sale can be done, but it's also a very kind of pro-level move, and it may not be the best fit for a first-time home buyer. It depends on your situation. So you want to be cautious about that. We walk you through what you can expect in the real world out there, and what your options are.
And so the comment, and then we're gonna have to wrap up because we're bumping up against our time, is okay, well, where do I get a value in the market? I'm just gonna give you my personal opinion on that. The value as a home buyer is, if it's not always the cheapest house, okay? It's just like with anything. If it's in a neighborhood that is popular and it's hot, you might pay a little more for it, but that means it's probably going to continue to be popular and hot, and you're going to take advantage of that increased value when you sell it and then move up. I'll give you a great example. When I bought my first home, I bought in 1995 in Plaza Midwood, paid $114,000. Thought I was crazy. I was looking to spend 90 grand, splurged, spent 114 on this house. It was in a hot neighborhood. It was right as Plaza Midwood was starting to really get on the rise. I sold that house 8 years later. Now, granted, we put about $120,000 into it while we lived there. We did an addition and everything. But so now what we've got $234,000 into the house. And I sold it for about $400,000 8 years later. And that equity that I had allowed me to buy the house I live in for the last 17 years. And had I not done that, it wouldn't have worked. So I did pay more in dollars than I wanted to, but it was a good value because it was a hot neighborhood. It was on the rise. And so I got to pick up that equity. So sometimes people are looking for cheap, and sometimes cheap doesn't necessarily appreciate, because you go into neighborhoods that might be cheaper for a reason. Now, if that's all you can afford and you just want a great house, then great, do it. That's no problem. But if you're looking for value, for appreciation, you got to go with what everyone wants. And sometimes that means you got to pay in for it now, but then someone else is going to pay in later, and you're going to be the beneficiary of that. So that's just my personal opinion. Nick may have some other advice.
Hey, Daniel, can I just get a final quick point? I'll be respectful of everyone's time.
Yes.
But you make a great point. When we're talking about value is all perspective, and we're talking about value today. What Daniel just brings up is that Charlotte is a growing market. We have what's called appreciation, right? And so you have appreciation of your value for, a year from now, 2 years from now. Charlotte's appreciation has been far and above the national average in the United States. So you guys, the value is if you are owning a home in Charlotte, that's the value, is that you're in a great market and a great city for that. And so your home ownership, the value of that, if you feel like you might have overpaid a little bit today, well, just wait till it appreciates. Like you said, if it's in a good market, good area, you're going to feel a lot better when, you might be able to sell that home in a couple of years and have it be valued a lot higher than it is when you purchase it.
Right.
Yeah, no, that's a great point. And I am going to go back to my slides as we wrap up. And I just want to thank Nick, who I misspelled. I'm so sorry. It has a K on it, everybody. So my apologies. But I want to thank Nick for, being with us tonight. You gave us some great insights. Matt, Brenda, again, great insights. And we really appreciate each and every one of you attending with your questions. I want to remind you, if you get pre-approved, we're going to give you that Legion gift card. You're going to get an email in a while with those booklets to download. Make sure you do that. We're also going to have a little survey. We really value your survey. We want to know how to make this the best event for that we can for the next time. So we want your honest feedback. And if you schedule that pre-approval, you can go on and click a little calendar thing and you just choose the time you want. And once you go through the process of getting pre-approved, whether you're looking to buy now or a year from now, get in the system, start working on that, get a plan together, and you're going to have those incentives from the EXP team and the TruLoan mortgage team. So watch for your email, and we just want to be a part of your homeownership journey. And as you launch it, whether that you believe is going to end up in homeownership in the next couple of months or the next couple of years, we want to be a part of that journey with you. So we really appreciate you spending your evening with us. It really it's fantastic to have this time with you, and we look forward to having some more one-on-one time through the pre-approval process with each and every one of you. Thank you so much for attending tonight. Have a great evening.
Thank you.
Thank you, guys.
Thank you, everybody. Have a great evening.